Tonight we're talking about real life property investment disasters and how to avoid them. Got some people that we're going to put on the panel, so I'm really looking forward to that. But puts things in perspective. I was at our Rouse Hill office earlier in the week, and there's a lot of noise going on around property at the moment, a lot of people talking things, and every time you open the paper there was something different. And I was speaking to a guy, and he inquired about putting a granny flat onto his property and another one on a property in Quakers Hill. And anyway, I got chatting to him, and he was talking about himself and talking about properties, and it came out that he'd been investing for a long time. He was in his 70s now. He had a nice $4 million home in Kenthurst. He had unencumbered, and he had 19 unencumbered properties, 5 with granny flats on them. He had a net income from his properties. He's like, mate, I'm just a lazy bastard, and he earned 250 grand a year from property, right? So quite often, in our business, and I'm sure in the accountancy business, we see people that are at that, aspiring stage and with still have debt and not at this other end. But I mean, he was, to motivate him and take him the noise out, he's got a thing in his study, he was telling me, where he framed it. It was from a real estate magazine in 1972, and there was a Bondi mansion there for $16,000. And there was also a property in Epping for a 5-bedroom house on 1,500 square metres in Epping for $8,000. So, you look at those things now and what they'd be worth, but, his point, and the reason he keeps that in a frame, is just to remind him that in the long term, property is a good investment, is something. So regardless of what's happening and the noise that's going on in the market, in terms of if you look at property over time and take the noise out of it, because it's not something we just get into for now, it's something that we look at from a long-term perspective, and take the noise out of it. So I thought that was a great way. So I did ask him if he's going to come on and do a podcast with us. So he agreed. So he's got some really great stories. So we'll get him on, and it'll be good to do a podcast with him and learn more. So disclaimer, this is just general information, so get advice, speak to the proper professionals, get independent legal and financial advice. We've got some professionals here that you'll hear from tonight, and some buyer's agents and so forth. So anyone that you need to talk to, we can put you in touch. A little bit about us. So my name's Ross Lacane. We've got some partners in the room. Scott Lacane is here. We've got Deb up the back. So Deb's one of our new partners who's been on board since 1st of May, as well as Tony. Tony's not here this evening. So we've got a good team. Over 200 years combined experience with our team. Our Aussie Parramatta has been the #1 franchise for the last 5 years, and we've recently won some bigger awards at the Australian Broking Awards in 2016, 2017. We love property, we're property investors ourselves. So our customer value proposition, so this is important for us. We work together with you to understand your needs and use our expertise to make it easy to reach your goals. I'll just invite Jeremy up, and he's going to introduce Keshab.
Thank you, Ross. I wish I was born back in the 1950s to buy Epping properties for $8,000. My name's Jeremy Anazelli, and I'm a partner at Keshab Chartered Accountant. We've been operating for over 10 years, and there's about 34 years combined experience between myself and Manzura. We've got about 21 colleagues. We are experienced property investors. We also love it. It's a passion, a little bit of a hobby as well at the same time. But Manzura, with over 23 years of experience, and myself with 11 as the group leaders. For us guys, it is about contributing to your life. That's what we do with all our clients, and hopefully we'll do it for a very, very long time to come. I'm interested for tonight. I'm interested to hear a couple of what our panel members will say. And also very interested to Scott. Scott's going to be talking about what's happening in the market as well. So I'll pass it back on to Ross and looking forward to tonight.
Thank you. So tonight's agenda, as Jeremy said, we'll give a bit of a market update with Scott. We'll go through, Jeremy and Scott will discuss with the panel. So we've got a number of guys and I'll let them introduce them. Then we'll go through some question and answers and some of the next steps. It was interesting. I was at a seminar that Aussie put on today, and the positive credit reporting is coming out. So NAB are already starting to report on all their personal loans and credit cards, and the other banks within the next month or so will start releasing all their personal loan and credit card details. So just a reminder, we did something a couple of months ago, but make sure on any bank debts, they're going to be able to report your repayment history over 24 months. So just a reminder to make sure you are regularly paying those cards, because the banks are going to be able to see them moving forward. And in the next 2 years, or by the end of next year, all the banks will have all your data, including all the limits of your mortgages and everything. So it's that is coming. So just a heads up. But to talk more on what's happening in the market in general, I'll pass it over to my brother and partner, Scott LeCain.
Thanks, Ross. If you want to grab the clicker. Yeah, some really interesting data came out this week from CoreLogic that I wanted to touch on. And as Ross said, there's a lot of noise out there at the moment in regards to what's happening in the market. So I found this really interesting, just breaking down what segment of the market is moving, what segment of the market is moving backwards, where are things up to truly when you're looking at the numbers. So I did touch on this last time. It's basically properties that are broken up into 10 segments, from the cheapest being number 1 to the most expensive being in the 10th decile there. And what this is showing is properties in the lower end of the market. This is the national list, but properties at the lower end have actually had some reasonable growth in the last 12 months. The blue is the last 12 months and the black is the last quarter. So there's actually been some reasonable results across the lower end of the market over the last 12 months. The major dips we've really seen at the higher end of the market, with 6.2% drop in that 10th percentile band. So it's the high end that seems to be dipping. So it's just interesting that the high end seems to be the one that's falling off the most, as opposed to the lower end of the market. And when you look at the lower end, it's only the 9th and 10th percentiles that have actually dropped by more than 2% over the last 12 months. So the rest of the market's actually holding up quite well. Sydney, if you look at Sydney, realistically the middle is holding up okay, but it is the higher end that is dropping in Sydney. We all know that. If you look at Melbourne, the lower end, I guess if you just go back and say, if you were to buy in Sydney, where would you aim? Well, you'd aim the lower end, obviously. You'd try and buy at the lower end if you're buying in Sydney at the moment. Is that what you would suggest, Paul? If you're going to look in Sydney at the moment, you'd be looking towards the lower end of the market?
Yeah, I spoke to Munzerl only a couple of days ago.
Yeah.
Some ex-government housing that went to auction only last week, and I think there was some properties within Campbelltown to Vale, etc., that were selling in that $360,000 to $410,000 price point for 3-bedroom, 600 square metre properties.
Yes.
There's some definite value there.
Yeah, so value, if you can find something at the cheaper end in Sydney, that's where you would be looking. Obviously, a higher end in Sydney, much harder to find some value. When they're talking about the 10th percentile in Sydney, they're talking about $2 million plus properties is that band. Over the 9th is about $1.5 million. So it's the higher end properties that we've really seen the big drop in. And that could be a capacity issue as well. So the ability to borrow funds, the banks tightening the screws, and the affordability of people is what's pushing those higher end properties down further and faster than the middle range properties. But you even look at the last quarter, even getting down to this middle range, the last quarter has been quite disappointing for those Sydney properties as well. Melbourne, same sort of story, but the last 12 months has been quite strong at that lower end of the market in Melbourne. Small drops in the last quarter, but the last year has actually been quite strong at that lower end in Melbourne. So again, if you're looking in Melbourne, I would be suggesting looking at the lower end where there's some opportunities, as opposed to the higher end, which is actually just picking up steam in terms of how much it's dropping in the last quarter. It's actually starting to accelerate in its decline. So Melbourne, if you're looking for opportunities in Melbourne, certainly look towards that lower end of the property market there. Brisbane, chugging along. The graph looks good, but it's actually 1.9 is the highest percent there. So just chugging along without doing too much at all. But at least it's positive. I think that's the thing that I take out of this. At least it is going in a positive direction. Again, the low end of the market here, as opposed to Sydney and Melbourne, the lower end really hasn't done a lot in the last quarter. It's the middle properties that have actually seen some reasonable growth in the last quarter in Brisbane, that if that keeps up, that'll give us 4% next year, 4 or 5%. So at least Brisbane seems like it's winding up in the right direction growth-wise, which is great. High end, not quite as well, but you know, the more expensive properties are holding up quite well in Brisbane compared to the Sydney and the Melbourne markets at that high end. I just wanted to pop this one in. This is it's like an upside down graph compared to the last ones that we've been looking at, and it's the Perth values. So the lower end has dropped off more in Perth than the higher end. So I think this is probably a reflection on what the mining boom busting has done to the market there in Perth. It's actually had more of an impact on the lower end, the workers, the unemployment lifting has had a worse effect on the cheaper properties, as opposed to the big end of town. It has actually had growth in the last 12 months in Perth. So those with money still have money and are still buying, and those properties are still going up in Perth, but it's that lower end to middle that seems to be running off harder. The actual decrease in property values in Perth from the peak, they've come off about 20%, 19-20% from peak in Perth. So there's some talk that it's bottoming out, but if you look at the last quarter, it's still quite a drop in values in the last quarter. So Paul, your thoughts on hitting the bottom of the Perth market? Doesn't look like we're there yet.
Yeah, no, it's a good point. I think what that translates to is a lot of the interstate migration issues and a lot of the investor stock that came probably on the market and is now the stuff that's not really getting picked up because there is no demand in that $200,000 to $500,000 price point. They're still struggling to find demand. Vacancy rates sitting above probably 6, 7, 8%. Yeah. And it's really those owner occupiers, the ones who didn't exit out when the market and the economy started to turn. They're still there, they're still earning good money, and those properties are still much more in demand, where that graph reflects.
So these properties were built with the mind that you've got all the fly in, fly out rentals.
You've got more domestic people moving in to try and take advantage of an economy that was booming, which now is not the case, and there's too much supply still within that market.
And you've got your nice owner-occupied homes down this end where people are still happy to buy and live. Yeah, right. Exactly. Interesting. Hobart has been a real achiever for the last couple of years, and we've seen great growth annually, lower end right up to the top end, with a combined 11.5% growth over the last 12 months. The last quarter, however, has been coming off, basically. So, I mean, I look at this graph and in my mind, I'm thinking if you're not in Hobart now, you've missed it, I think, is what this graph's sort of saying. Agree with that? Yep. Paul's nodding away, yep.
About 5 months ago.
5 months, just missed it. But interesting, but great for Hobart that it's performed so well. But really looking elsewhere to invest right now, I think. Canberra's an interesting one. Canberra's just full of public servants, so that middle ground property is what they're looking for in Canberra, and it's actually interesting just to see in the last quarter almost a 2% drop at the very bottom end in Canberra. So whether that's a starting point for seeing that flow on a little bit more over the next couple of quarters, over the next 6 months, a bit of a drop in Canberra, you might start to see that. But it has performed quite well over the last 12 months. But the last quarter seems like Canberra might be turning there as well. Paul, your thoughts on Canberra?
Yeah, I think you've probably seen the restrictions there from an investor perspective. Land tax at the lower end is an issue, and I think at the higher end you're going to see consistency. But coming up to an election now, when you start to see the public servant sector and the housing sector start to become a little bit wavy, and you look at it tracking every federal election, you start to see really similar graphs, because
who's moving in, who's
moving in, who's moving out, and
yeah.
who's a bit trepid. Well, there's a bit of trepidation about job security for the next government who's coming in, and you start to see that people don't necessarily go out and want to upgrade or buy that investment property, even if they live in Canberra at that time as well.
Very good. But yeah, that's some slides on where the market is segment by segment, because we say a lot that there's markets within markets, and it's trying to say, well, where do I pick where to buy? And I like this type of data because it says, okay, well, Sydney, if you're buying, buy low. In Melbourne, if you're buying, buy cheap. If you're buying in Brisbane, buy middle of the road properties, don't particularly buy cheap. If you're buying in Canberra, look at those middle of the road type properties. If you're buying, it was interesting in Perth. If you're buying, buy expensive. Go somewhere an owner occupied would like to live. So you've got to take the data for what it is, but also try and take away what you can in regards to where should I be buying within market segments. So interesting. Any questions on any of that Paul or I might be able to help with? Montreal, any comments on any of that?
Just a couple of comments, if I may. I was looking through some of the slides, and I sort of, I suppose, note a couple of my observation. The first observation that I sort of see is that Sydney is probably leading the way, right? Yeah. So you can see that relatively Sydney sort of is the decline in there. And part of the reason is that Sydney sort of had quite significant sort of growth in this particular cycle as such, right? So that's the first observation which I can see. I agree with you with the Brisbane market that even though the graph looks fantastic, but do we really have the high level of the return? But to me, it is still reasonably positive, the Brisbane market side of it. The Hobart my comment is the similar sort of comment that the statistics are there, but we are a little bit late. So I suppose some of the general sort of the comments that I make from my point of view is I invest into the property by looking through the underlying statistics, right? So you look through those numbers and I sort of say that, well, fundamentally for any investment, it's about the return. So what's the return that we're receiving? So if we sort of compare any property, say Sydney property as an example, you hardly get about 3.5%, 4%. If you look into Melbourne, you probably get more or less similar, a bit lower. If you look into Brisbane, one probably argues that you still get about 5%, depending on where you buy, and so you get more than 5% as a gross return. However, the numbers are pretty good, but it's sort of increased quite a bit. So to me, by looking through that underlying sort of the rate of the return, which is the rental, that Brisbane market still has quite a bit of value proposition. So that's my view. The other comment which I sort of say is that the statistics are fantastic, but it is, I suppose, a quarterly statistics, annual statistics we look through from the longer period of time. And equally, I make the comment that these are sort of, I suppose, residential as such. And I would be equally curious that where we are with the commercial side of it, yeah. So these are just sort of some random sort of observation from my point of view. Just out of curiosity, when Ross gave that example, brilliant example, that the property in Bondi Junction for about, say, 16 odd grand back in 1971, and Epping for about 8 grand in 1971. What I was curious in my mind is to sort of say that, well, how do we compare apples with apples, right? How do we compare the perspective? What was the median income back in 1971 as opposed to the median income that we're looking through now, right? So, and I must admit, I've done a bit of Google search to sort of see what was the median income back in 1971. And it was about 10,500 was the median income in 1971, the family median income based on which statistics you see. And the median family income at the moment is about 107,000. Right, so we sort of compare that sort of 107,000, we sort of compare that with sort of 10,500, and we sort of say that, well, while the prices seem brilliant at that stage, is that it was in that sort of a period of time, with that sort of a median income, it was a still expensive price, right? So property investment is always expensive when you consider it. But in the longer period of time, you look back and you say, wow, that was pretty good buy. Thank you.
Thanks, Munzrul. Yeah, it's interesting, and just to look at Sydney, as Munzrul touched on, it looks quite negative, but if you actually look at the papers and some of the media commentary in the last few weeks, it's quite strange, they're starting to get a little bit more positive on the market. And just today there was an article in regards to the Inner West saying the Inner West supply is so low that it's actually seeing good prices and some growth in suburbs like Annandale. There was an article on Melbourne and Sydney and the 17 lucky suburbs that still see growth, and like Beaumont Hills was there for New South Wales, where they're still having growth within Beaumont Hills. And there was talk of an auction that happened in Carlingford on the weekend, where there were 12 registered bidders for a deceased estate in Carlingford, and it sold for 115,000 over reserve in Carlingford. So these are the numbers, but there's still shining lights out there in the market that is a positive spin, and it's about looking for opportunities and finding those opportunities within the markets to take advantage of. So interesting. Jez, do you want to introduce our special guest tonight?
Beautiful, thank you, mate. Thank you very well. Lots of things that I've learned as well, which is good. So what I'll do is I'll just introduce our panel speakers today. We've got Richard Williams. Richard's going to be talking about some development pitfalls, things that he's done, things that he's seen and things that he's learned. So thank you very much, Richard. We bring back the man, Scott McManus. He joined us last year as well, and he's going to be discussing all things about managing the manager. Lots of stories that you've got, Scott, across your quite expansive portfolio, and we're going to hopefully share all the good things and the bad things as well. We've got Prashant. Prashant's going to be discussing all about lending issues. So obviously with his knowledge around mortgage broking and being a property investor as well, with quite a number of properties in his portfolio, he's going to discuss everything that he's seen in the market, not just from himself as an investor, but things that he's seen with his clients as well. And we're going to bring our guest speaker, Frank Alvaro from AES Legal. He is a solicitor, principal solicitor there, and been in the industry for 25 to 30 years? Over 30 years. And he's going to be talking about contract and legal issues that he sees, things that he discusses with his clients, probably a couple of issues that he gets his clients out of as well. So I'm very keen to hear some of the stories. But what I'll do is I might pass it on to Scott to get the night started, and he can have a chat with his speakers.
Thank you. So Scott McManus is a client of mine and a good mate of mine. He's a landscaper by trade and as a great landscaping business. Also is a mad property investor and has got a great portfolio, one to be envious of, with properties in Western Sydney where he's put not duplexes, he's put granny flats on them, great cash flow, and he's diversified his portfolio and bought properties in Brisbane. And what we're going to talk to Scott about tonight, he's got a great story to tell, or a number of stories to tell, in regards to managing agents. And managing your managing agent. If you just set and forget with a managing agent, some things can happen that Scott will talk us through, and then hopefully we'll get some learnings out of those experiences, and we'll all come away with a better idea about how to manage our managing agent. So I guess, Scott, if we just start a few years ago, you went from your Western Sydney properties, you saw the opportunity up in Queensland, and you said, right, I'm gonna start buying up there, and you were buying properties through a buyer's agent up there. And then it was time to go and visit those properties, and you and I both went, and we were looking at properties to buy as well as doing property inspections. We did probably 5 property inspections of Scott's properties while we were up there. And do you want to just, I guess, talk us through that experience as a starting point?
Yeah, g'day. It was really interesting because I had 6 properties down in Sydney, or 6 front doors anyway. And they were all chugging along really well. So I'd become a little bit complacent, and that was my own fault. And if you want to go into property or any investing, you really got to be an active investor. You've got to be somebody that takes care of your own nest and don't rely on anyone in particular to do it for you. In saying that, we have agents, and we do that so that we don't have to be looking at it 24/7. So when Scott and I flew up there, we thought, okay, we're going to have a look at a bunch of properties and go through them, expecting to say, yep, everything is nice and dinky-dory, and that made me feel really good, and I'll fly back home. But instead, I needed a pen and paper, and as we walked through individual properties, there was real obvious concerns of a list growing for every property of things that just weren't being looked after or weren't being managed. And I put my trust in an agent that was in another state. I'd actually bought properties through that agent, and assumed that everything was going well. That they had, I guess, I assumed that they had my best interests at heart, and that was my big mistake. So we started looking at properties and realising that front doors were hanging off hinges, and lights weren't working, ovens weren't working. Started talking to the actual tenants themselves, and they had a list as long as your arm of things that weren't being taken care of. What it did is it was a bit of an awakening for me that I need to start managing my agent, my manager, I guess, the person that is looking after these properties. I need to start making sure that they're doing their job, or start looking elsewhere.
So, yeah, it was interesting because all of the 5 properties were managed by somebody different. So we're meeting different agents at all the different properties. But it was all the same. It was all consistent in that there were simple things, basic things that you would walk in and go, that needs to be fixed, that needs to be done. Why isn't it being done was the question. And from there, you made a decision to go to one agent. Talk us through that.
So my thought process at the time was that if I can, apart from paperwork, when you have multiple properties, there seems to be an awful amount of paperwork, and things being thrown at you from every direction. Of either maintenance or where statements are at, or what bill goes with what, and who's paying what, and am I paying this, or are they paying that, or did they pay that, or so all of these things started to become a bit of a juggling exercise. And my poor old wife, not my old wife, my poor young wife, glad she's not here. I tend to lump a lot of that on her to look after, and she's wonderful and does a great job.
So it made sense to centralise paperwork, contacts, and centralise the management of all the properties.
Exactly right. So I decided if I could have one person to praise and one person to fry, it'll be a whole heap easier from my point of view. So I put all my eggs in one basket with one real estate, and it did help quite a bit actually. I'm not opposed to doing that. It worked really well. That meant that I could have regular statements from the one person. If something didn't look astray, I could ring the one person and find out what's going on. I then made sure that every bill in any shape or form came out of and on that statement, rather than having some bills to me and some to them and some all over the place. And that also helped a lot. Where complacency starts to set in, and this is what started to happen, is that I started to then trust that agent that I now no longer need to manage my portfolio. Yeah. And that's you would think you would learn it the first time, but yeah.
So he had an idea for you with one of your properties. It was Queensland style, and it had room downstairs. And do you want to talk us through? This is where we start getting into some issues with managing agents and things. But he had an idea of obviously generating some extra rental income. Do you want to talk us through what happened in that scenario?
Sure. So Scott, of course you can convert downstairs. I know it's not legal height. Everybody does it up here. It's fine. It's Queensland. You can get away with it. They're the words that I heard. To me, I'd had multiple incomes on my properties in New South Wales, and it worked beautifully. So I thought, well, sure, I'll turn it into. I'm a bit of a risk taker. I thought, I can turn this into a granny flat downstairs and convert it. So I spent a whole bunch of money getting him to convert it, or getting his tradespeople to convert it, and he was taking a 20% commission on managing all of those trades for me, like any builder do, and I had no problem with that. Except that when I then flew up to inspect the work, it was shocking. I'm a tradesperson, so I've got a bit of an eye for detail, but it was worse than bad. I walked into the bathroom and the tiles cracked as I walked over them. Floorboards were already 10 centimetres above where they should be. It was like walking on a cushion. Anyway, multiple things were very obviously wrong with the quality of the build. And I got photos along the way, and the photos all look great in photos, but touching and feeling, it's very hard to replace that. So the managing agent did the wrong thing by me, firstly in the quality of the build. Once these things were rectified, it only took about a month or so before council came knocking on my door about why I had a multiple dwelling property on one that wasn't allowed to. So
effectively next door complained about the cars. Somebody complained, and council contacted the owner about two rentals.
Yeah, so I get the letter from council saying that this needs to be rectified. We want to inspect immediately. So I press the panic button and ring my agent to go, well, you told me that it was all going to be okay. And then, of course, he throws his hands up in the air and goes, well, there was a risk. Maybe everything isn't okay. But I just forked out all this money. Now we're going to have to convert it. Don't worry, what we'll do, we'll rent it to the one family for upstairs and downstairs, and that'll solve this. And we'll let it go a month or two. And once that person is wanting to move on, we'll do it again. We'll rent it to multiple people again. Council won't mow, it'll be all good, be dinky-dory. Again, council come knocking on my door. They weren't dinky-dory. They weren't particularly happy at all. So I started getting threats for legal action and fines and all the rest of it. So in the end, that property is rented to one family. I'm no longer getting my dual income. I am probably getting slightly higher income than I would have otherwise, but it's lesson learnt, and it's me now realising that I need to take responsibility, not somebody else take responsibility.
Yeah, it's
my property.
It's the same as buying a property, isn't it? That you've got to do your own due diligence on that property. It's your decision at the end of the day to have an understanding of what you're buying, what you're spending, what the value is. It's the same when you're dealing with agents and things like that. You've got to do your own due diligence, understand the rules, understand the risks, and do your own due diligence on any sort of transaction like that. So that's played out where you're only getting single rent on that one. Moving on to, I guess, more towards today. bills start to come in when you've got a investment portfolio and you've got 13 odd properties or however many you've got. You get bills for things, and the very simple thing is to just pay them and just move on. Do you want to talk about, I guess, if we start with tree lopping at one of your properties? That was quite a good story.
Okay, so there's a particular property that I got photographs from the real estate saying that there are trees encroaching on the property, leaning on the guttering, and potentially going to cause a big problem. The tenants brought up the issue, and the real estate took some photos and sent them through to me. I'm looking at the photos, being a landscaper, and I sort of know what things are worth a little, which is a bit of an advantage. And not really understanding why the quote doesn't match the scope of works. So I talked to the real estate and say, listen, can we get another quote and just double check this? Which he does, and a pretty similar price that comes back. And I'm like, wow, man, Queensland, they're really making some money up there. I then decide I'm going to ring a mate. I'm going to ring a mate who I can trust to get an independent value on what this is. So he goes out and gets another tree lopper to have a look at it for me. The price came out at less than a third of the original. So the original quote was for $1,800, and I ended up getting it done for $450. And that's just one property. There was another property where tenants hadn't been in for a while, and I decided to get a lawn mowing guy to go out. And this all came about because I got a bill for the previous month of $380 for a lawn mowing on a residential property. I thought, wow, that's some serious lawn mowing they must have done. So I organised it. Just by a stroke of luck, I actually rang the exact same person that the real estate had rung. So when he gets out to the property, I asked him, can you go out and price up this lawn mowing for me? He gets out there and realises that I actually mowed this a month ago for you. And I go, well, how come your quote's $65 today, and a month ago I got a bill for $380? You go, well, you didn't. It was $65 last time as well. What are you talking about? So there was a real estate taking a certain percentage there.
So that's where it comes to managing your managing agent. If you just pay the $1,800 to have a branch lopped, and the real estate's not doing the right thing by you, you're paying an extra $1,000 that you don't need to be paying. And so it's really managing your managing agent, where you don't feel like you're down here and you don't feel like you should be doing that. That's what you're paying your 5, 6, 7% for. But this is the reality of what's happening. You're getting charged $1,800 to do a $400 job. You're getting charged $365 in lawn mowing when it only costs $65. And a lot of this time, if it's under $500, they'll just take it out of your rent, and it just shows up on your statement. So you've really got to spend some time and have a look at what you're getting charged and ask for the quotes. I've got Hipages on my phone now. It's the app where you just go, it's got all the different trades, and you can just go, bang, I'm in, Waterford, I need tree lopped, and someone can go, you get 4 come back to you in 5 minutes and say, this is what the price is. So you've got to take a bit of initiative yourself to be able to say, this is what I think it's worth. So as Ross says, property isn't a set and forget model, but it's a set and don't worry. But you've got to be involved. It's not a passive investment, and that's annoying because you're paying a fee for somebody. But that's actually the reality, isn't it?
Unless you're going for a defence force housing or something along those lines, where you're paying up front at 20% commission for them to take care of everything, and when the tenant moves out, they'll paint it, recarpet it, that sort of things. If the washing machine blows up, well then they'll replace it as part of that 20%. So that would be the only scenario where I go, well, that I can see of anyway, to set and forget, or at least for the length of the loan, the lease. Sorry. But there's a few things I've learnt in finding an agent now, which is a bit I'm a little bit more vigilant about it. I definitely like to interview my agent and find out how many people do they have on their rent roll, find out how many staff are actually looking after rents, and how long have that staff been there. Are they people that are 16 years of age and just straight out of school, or are they people that are been there for the last 5 or 10 years and have got an invested interest in the business? I really like to be able to have the one person to talk to. So when I appoint an agent to look after my property, I'll say, okay, well, who is it that's actually I'm going to be talking to? If I've got a problem, who am I ringing? When it comes up to re-let, who do I talk to? Because I only want to talk to the one person, so then I can. Behind the scenes, I know in reality they're running a company, and I don't mind who's showing the house and who's doing whatever else, but I want to talk to the one person. I want to know what's going on, be able to ring them up, know that I'm on their phone. It comes up as Scott McManus whenever it comes up, and they're going to pick up the phone. I'm not a hard ass to anybody. I try and to be fair and nice and understand that everyone's out there to do a business, but I do want to be able to praise one person, and I want to be able to fry one person, so that's big for me.
So you removed all your properties from that managing agent, and have you transferred them all to another one agent?
I have, yes. And the way I went about that was I first started, a lot of my properties are in a fairly central location, so they're not too far from each other. So I felt comfortable about having the one agent look after all of them. But I started researching on real estate and domain who had properties for rent, who was dominant in that area, and found 2 or 3 that I felt that were really dominant in the area. Then rang up and asked to speak to who is in charge of all of the rentals. So you're talking to not just somebody, you're talking to the person that's running the team. From there, I'll ask them questions like I mentioned before: how many do you have on your rental roll? How many staff do you have? And those sort of things. I put them all together so that we can again have everything. I put all my properties with one, so I can have one paperwork and that in line really easily. Another thing I asked to see is can I have a look at a statement? Some statements are really difficult to make head and tail of. So having a statement that is really clear. So my current one, the very first page that comes up on my email is how much came in, how much came out, how much was deposited, and then it goes into the statement. But that's the very first thing that comes up, so I can at a glance sort of go, okay, what's going on here? So that's been really helpful.
Yeah. Thanks, Scott. I mean, lots of great tips there, and managing your managing agent is such a big part of your portfolio. And like all these guys are going to talk about issues in the market at the moment, I think in a buoyant market that we've had, it can cover a lot of mistakes up that we're made with property, because the market's been so buoyant and rents have been high and vacancy rates have been low. But they say it's when the tide goes out, you see who's swimming naked, and I think the tide's starting to go out. So if you're not well organised, you're not well prepared with your managing agent, you're not right on them, they know if you just pay the bill, they can throw an extra $1,000 on it. So you've got to be on it.
Scott's is not a rare case. I see it all the time with monthly statements. I've had clients where they've paid the same plumbing invoice 4 or 5 months in a row, and all it was a plumber going out there for 1 hour because the tenant flushed the nappy down the toilet. And there's the things that I brought up with the client brought up with the property manager, and all of a sudden the tenant reimbursed 5 out of the 5 plumbing costs because the plumber's report said that they removed a nappy out of the bathroom.
You've really got to look at it. And another story, I won't get Scott to run through it for the sake of time, but really quickly, property that was empty for 4 weeks waiting to be rented, managing agent saying, yes, it looks beautiful, we're just not getting the bites. The grass was up to your waist, the place was filthy and the back door was open. when Scott's mate went round. So if you're out of state, ask for photos, ask for a video walkthrough, ask for the comment sheets from the open homes. You've really got to manage your managing agent, even though you feel like you shouldn't. You really need to manage your managing agent. Thanks very much for sharing, Scott. Thank you.
All right, guys, I'll introduce to you Richard Williams, and we'll be discussing a little bit of his past experiences, especially more so to do with some development, I suppose, pitfalls or development properties that he has purchased and lessons that he's learnt. Richard himself is an experienced investor. I've been assisting him for the last number of years now. Lots of research. This is a gentleman that goes into his property deals with the numbers. He understands the market, does a lot of different feasibilities to understand where the property is or what things may happen. And I suppose it comes down to practical experience as well as the numbers as well. So Richard, do you want to share a little bit about yourself, and we'll get into your recent development deal.
Thanks, Jeremy. I guess initially my first purchase was a property I lived in, and then after that I saw some friends from work that had done developments, and I thought, this is a better way to make money. So I started on my first little development project. It was a duplex down in Adelaide, about 2007, 2008. A syndicate of a number of guys from work. There was about 6 of us involved in that one. It was just a duplex, but it was in a smaller suburb, so it was hard to get comparable sales. Again, the guy that had done a previous project, we were probably relying on him substantially as being our expert. Then the global financial crisis came along, so we had a DA for some nice 4-bedroom double living area houses. We demolished the existing dwelling, and then we had problems with finance on that particular property due to the lending environment at the time. So we ended up, we on-sold that one, because again with 6 people, everyone's got a slightly different risk appetite. Should we throw more money into it and build and have a couple of houses that we can then sell, or do we kind of get out where we are? We'll take a bit of a loss, but we're out of it, we can move forwards. So that was an interesting scenario there. That was my first development deal as a joint venture with multiple people. From there I moved on to a duplex, so it was 50-50, just with some friends. Took the lessons from the first project into that, and again that was some good lessons, because we thought we knew a fair bit, but there was lots of things we didn't know. So just quickly, the main little gotchas on that one would be your Section 94, your council contributions. What the hell's an open space fee? Why is council sending me this bill? Connections for new water meters, a block that looks nice and flat. How's that stormwater get off your nice flat block? When the builder comes along and says, oh, actually we need to raise everything 30 or 40 centimetres, so we've got to bring in this clean fill. Oh, and by the way, we're not just going to get it for free, you have to pay someone to bring it around. Then all of a sudden your block's that little bit higher, so maybe you need a retaining wall down the side, under the fence, and there's another $4,000 or $5,000. And then your fencing just at $70, $80 a linear metre. So just on that one, there's like 5 little nice lessons. None of them were particularly expensive overall, but let's call it about 20 grand for water meters, council contributions, retaining walls, fencing. So an opportunity there to learn some lessons, and in a relatively kind of low risk environment, just with a duplex on residential finance.
And Richard, I suppose the big thing there is that these are the so little things that you don't think of. Normally it's about the taps and what toilets am I putting in and how high do I want the ceilings and what paint do I want to use, but we tend to forget the little things like the council contributions or retaining walls, and no one knows what the cost of the retaining walls potentially may be until obviously the block's been cut or the house has been finished, and it's hard to always factor in those particular costs if you haven't gone through the actual do yourself.
It certainly is, Jeremy, and definitely that the team and the people you're working with, and on a little project you might go, oh, this is nice and easy, and then you jump into it and it's like, well, the builder's not going to tell you about that. It's just a nice little variation for them for a retaining wall, where you go, I'm going to do it myself. I might put the air conditioning in at the end, and then you've got to decide there, do I get that extra on the home loan? My home loan's a bit bigger, but then the builder puts their 20% margin on it. And a few of those little things, if you're spending that extra 20 grand, say, on a 20% builder's margin, there's an extra 4 grand you pay the builder, so you can roll that into your home loan. Or do you go, 20 grand, I've got a bit extra, I'll decrease my deposit a bit, I'll save that 4 grand, and then you've got to weigh that up against perhaps the builder won't hand it over, the builder won't let you put air conditioning, for example, into a house until they've handed it over to you. Depending on where your agent and the market's at, do you need air conditioning before you rent it? Can the agent show people through, or they say, you know, you really need to finish off those couple of jobs over there? And then you might have a couple of weeks of holding costs. So maybe some things you should roll into the build contract. So there's lots of little things that you don't even think about. You might think you might save a bit of money over here, and you end up paying a bit over here. What should you do? Best thing you can do is go in with eyes open and speak to people that have done it before. Don't think, oh yeah, this is nice and easy, I've built a house before. Or, I mean, that's a good start, but it's not, it's simple, but it's not easy.
I think we've had lots of clients in the past who, when they've done this, the expectation on their first one or two is not to make profit. Absolutely not to make a single dollar. And it sounds crazy. Why go through all the pain? Why go through all the hassle to make absolutely nothing? But what you're doing is, what you've learned is you've built a formula. You now understand a couple little things that you've learned from the first one or two, and that formula now is becoming more complete every time that you do the next deal and you do the next deal. And I suppose you can test different boundaries, but each deal has its own formula essentially. It's just a matter of manipulating it. Would that be right?
It certainly does, Jeremy, and you might look at it as a property investing journey, but it's as much or more so a personal development journey. Like when you get that little variation, you get home after a day in the office and your variation's there for however many thousands of dollars, you might not sleep well that night. You might go, oh geez, I haven't factored that one in. If you're cutting it close to the line, it's like you've got all these emotions and stuff. You were just building a house. Where did all these emotions come from? So it's a journey, and like you say, Jeremy, like signing build contracts, signing contracts for sale and purchasing properties and stuff. It's like, yeah, whatever. It's those things become...
A lot of the groundwork is at the building contract, isn't it? Because I've recently gone through some building contracts myself, and I've seen estimations for drop beams at 20 linear metres, and I've done a quick calculation. I'm no mathematician, but I worked out quite quickly there was probably about 80 square metres of 80 linear metres of drop beam, which changed the price from about 20,000 to about 60,000. So scrap that off the build contract, and lots of other little things. So I suppose it starts from that building contract, it starts from those ground numbers, and then you've worked it into practicality. So talk us through, recently you went to a couple other bigger things. So you went away from building duplexes and building it with friends, to doing things on your own and looking at larger developments. So talk us through one of the recent ones you've done, say up in Newcastle, and a couple of the things that you've learnt, a couple of things that went wrong, or a couple of things you've done right.
Got a bigger project up in Newcastle, and again learnt lots of lessons from that one, things not to do, people I should have listened to more. For that one, because I'm here in Sydney, I opted to get a local project manager to assist me with that. So they came across and, oh Richard, this is fantastic, we've got this great opportunity. And I've been looking in Sydney, up to Western Sydney, around the Penrith area, and hindsight's a great thing. Back when I was looking there, prices were in about 500,000 for a 5 townhouse block. Now they're about 1.1. That's just for the block. The finished townhouses have gone up from about 360 to 620. And in the meantime, I've been tied up for a number of years with this project. And some of the things that were an issue there, particularly on the council side of things, when council owns the infrastructure and the easements under your block, it's all well and good for, say, Hunter Water, Sydney Water or someone to say, yeah, here's our infrastructure, but there's lots of things that you can have to replace and improve on behalf of those councils and utility providers. So one example was, I was aware that I need to upgrade some sewer pipe. So I factored in about 20 to 30 grand for that, and that one ended up being closer to $50,000. So that was a bit of a hit.
So just with the deal itself, explain, probably for people to get a bit of a picture, explain the block of land, I suppose the contours of it, the size of it, and what you're going to do with that land. So you saw it was a raw piece, what was your vision for it?
Okay, it was 3 adjacent properties. So it was 2 full houses plus the backyard of the neighbour's property. He was going to, or did keep the existing house, and that would leave me with 2 existing dwellings that I could on-sell, and it gave me about 2,000 square metres to the rear of those houses, where I could put a double driveway between those 2 houses and build 10 townhouses at the rear. The block itself is reasonably steep. It slopes down, then it has an overland flow type area at the back, and the plan was to put a small walkway across that, and then put another of the 10 townhouses, put 6 of those behind that. So it would have a common car park area. Just as you come down the driveway, you'd have the car parking area. So there was a bit of slope on the block, so there was going to be some retaining walls. In the big scheme of things, it was a relatively complex build, and that's caused a number of my issues with regards to, particularly in the market over the last couple of years. It's been a hot market, so builders have been in demand. So when there's lots of nice flat blocks and they look at one that's got a bit of slope on it, they go, you know, that one's a bit trickier, I can pick and choose my jobs, so I'm not going to bother quoting on that particular job. So that was probably my biggest issue, was lack of builders, or alternatively, if they were prepared to do it, they could put a premium on the block price. The particular suburb I have the property in has grown a little bit, but it's more of your affordable type suburb. So while Merriweather, Adamstown, Cooks Hill, all those sort of areas have gone up significantly, this particular area has gone up, but in sort of the single digits percentage-wise. So the development deals are still, they've been really stacking up in those middle to upper areas. The build prices have gone up lots, but then so have your sale prices, so that's kind of taken that. Whereas my particular deal, the margins have been eaten into by that rising build cost. The difficulties on the block, I had another difficulty where I needed to demolish a garage to the rear of one of the houses, because underneath that garage was where I could fit 3 townhouses. The guy that lived there worked for council in the 80s. He got some nice cheap free fill from somewhere. That was contaminated waste with asbestos, so I paid in the tens of thousands of dollars to dispose of that. I'm happy with the asbestos in the eaves or a bathroom or something. That would normally add a couple of $1,000s to your demolition, but this one was in the tons, so I got a nice bill for that one. Unfortunately, that was one email that I opened about 10 o'clock at night before I was about to go to bed, and I didn't sleep so well as I should have that night. But again, it was a variation. The builder was entitled to charge it. He had the receipts from the landfill, so I was not able to do that one. The one where I was upset with regards to, well, my project managers should have been present when all that was happening. They weren't, and there's been sort of some issues there with, I guess, people that should be actively managing things on your behalf. Again, similar to the agents, sort of make sure that they are. If someone says that yes, they know the area, they have the contacts for the builders. One of the lessons I learnt there, yeah, Richard, it's great. Yep, this build's fantastic. We've got the local relationships with the builders. The words that were said and the actual realities behind it were different. So again, I did, particularly on that build price, rang a number of builders, got some build prices for other jobs they were doing. I guess what I didn't pick up was some of the undertones on, yes, we could build it, but again, with the slope, no, we don't want to, we choose not to. They weren't words they said.
It's definitely been challenging, hasn't it? Because I remember when we sat down, we did the feasibility, and the numbers were looking in the right direction, and the builder came through with this fantastic quote. I remember this very thorough, probably 30-40 page breakdown of the overall cost. You say, I trust it, because there's so much time and effort that this builder's probably put towards building this quote up for Richard. And then all of a sudden, when things start to get a move on 6 months, 8 months later, Richard, definitely that price we can do, but we're going to probably have to add about another 150 or 200 grand. And it kept going up. It kept going up. So even with the numbers being pretty much polished, our hands are in this builder, and the prices just kept going up and up. Every 6 months he was lifting his price another 100,000, and it turned our feasibility from where it looked all right into something that, our profit, our margin's really getting chewed up. So I think that's something you really need to look at as well, especially, Rich and I have had lots of discussions, and it's locking these guys in. It's keeping them to their word, and I suppose it's moving through it a lot quickly, so they just can't think about going on to the next job or the next deal. So you've gone through all that. We've had a lot of issues. We've had asbestos and all the other problems with it. I like to look at the resolution. So now we've got a development site. It's still there. What have you done to resolve a couple of these issues?
Okay, well, current options I'm looking at is possibly sit on the site for a bit longer. As we've heard, the market keeps moving. There's holding costs associated with that. Or one I'm looking at the moment is an actual redesign of the site. Yes, the profit margins won't be there. However, it'll simplify it. I won't get my yield of 10 townhouses, but it gives me an opportunity to go, yes, a few lessons there, things didn't go according to plan, but I can move on and roll on to the next site. So again, a couple of options I'm looking at there, or things that even with the current plans, I looked at staging the developments. Being 10 townhouses, the DA I got from council was build all 10 at once, but there are options to go, I'll build 3, and then I'll sit on that, and then I can build the remainder, the next 7, alternatively maybe the next 3, then the next 4. The site layout doesn't lend itself easily to that, but it can certainly be done. There's access through adjacent properties and other types of things. So those are all viable options. But again, it's when plan A doesn't work, it's like, what are your options? What do you do? And I'm working through some of those at the moment.
And it's good to see that you now, I know with a lot of other seminars that you speak at and you go to, you do help a lot of people with, feasibilities, and you share your stories, and you've got an understanding of costs now as well. And I know you actively go out there and really try to help as many people as you can in that development side of things. I'd like to hear what, I suppose, the biggest 3 things that I suppose you would say to everybody here who's looking to do a development, maybe in Queensland or Newcastle or somewhere where it's not 15 or 20 minutes from home, where they can't go and see it every single day. What would you say?
Look, there's some fantastic people out there with regards to property development and sharing their knowledge. There's a few courses out there. Yes, you might pay 5 or 6 grand, but the reality is if you get the right ones, you can learn a lot, and you learn the right questions to ask people. Certainly I've developed stuff interstate. Hell, I've got properties in Perth, I've never seen them. People are like, oh, do you want to get some flights over there? And I'm like, why bother? I don't want to see the houses, it doesn't change them at all. And you just do that through having a good managing agent. Like with 3 properties, I used the agents lots. They were renting one of the properties, but for the promise of getting the lease or the rental on the next couple of properties, they were happy to go out and organise trades. They put key safes out for me. When it came to handover, I was getting photos throughout the build process, so I could see what things were happening. You could pick up things from all the decent photos and videos, like if a door was painted the wrong colour, you pick that up and you check the build contract, get back to them and get that fixed. In getting quotes for fences and the like, just get a little PDF file, mark it up in red. I'd like some fencing here, here and here. I don't need to be there. Stuff where someone did need to be there. Again, if there was a key safe installed, hey, just call me when you're there. I'm not sure if I'll be able to make it. If I can't, I've got a key, I'll be able to let you in. So you can definitely manage things remotely. But again, you need a couple of people you can trust. Some of the easier options for that are the leasing agents. Depending on how you find your builder, or the builder I used was through a building broker. So the building broker's reputation was also on the line to make sure his builder developed a good product. So I used him to actually go around on a couple of occasions and just have a look to make sure things were right for me. I also used handovers.com at the end of the project just to make sure everything was built to code. Paid a little bit for that. So you certainly can do things, but again, make sure you've got that team and make sure you're learning along the way to get the right questions to ask people.
Beautiful. Well, thank you very much, mate. Thank you very much. I'll pass it over to Scott.
Yeah, so we're moving on to lending issues now. Prashant Alambara, he's an experienced investor in his own right, but also an excellent mortgage broker, and he's sitting in front of a lot of people day in, day out. So what I want to pick his brains on tonight is really what are the issues that he's seeing in regards to lending, and what are the common mistakes that people are making when they're first applying for finance. So I guess the environment's changed a lot, Prashant, now. What are those common issues that you're seeing day in, day out with people that are coming to borrow money to buy in this market?
There's not a given day that I don't see some lending issues. I think people, they tend to want to get into property investing, but they don't create a plan as such. So they don't understand what the next move they do and how it's going to affect them moving forward. So a lot of people have purchased quite bulky assets, and now they want to make movement into other assets, and it's quite hard to do that with the current servicing issues that have been posed to a lot of these clients. And another option is that they'll all have their eggs in the one basket with the one lender. So they might be cross-collateralised, and at the time it was convenient for them to do so because their bank manager said, we'll make it easy for you. But now they're trying to release equity, and it can pose a problem because when you cross-collateralise, you'll have 2 assets or 3 assets, and one might have gone up in value, 2 might be dormant, or they might have gone down in value, so it's hard to access the equity. So those are a couple of the little things that we're seeing at the moment, and it's trying to work with our clients to see how we can undo and help them move forward in the next step of their property investment journey.
Yeah, and I guess if you're going directly to your bank, often it's easier for that lender to cross-collateralise things. It's just it's the easiest way for them to structure it and do the loan. So if you're going directly to your bank, and St George is probably the classic that does it, and they'll just cross-collateralise everything because it's the easiest thing. It's the easiest thing for them. So I guess, can you give us some examples of some issues that you've seen recently, potentially with, say, off-the-plan purchases or buying land and waiting to get your construction approvals, those types of issues that are rising?
Yeah, that's quite a common one at the moment. A lot of people have purchased land, they purchased it, 18 months, 24 months ago, and they're now coming up for settlement. And they had grand visions to build a castle on that block of land, but now they might be coming up with servicing issues because back at the time, the bank said you're good for $600,000 or $700,000 for the build, but now with all the current lending requirements that have been put into place, they can only get $400,000 or $500,000. So some of the things I say to these clients is look at revising a cheaper building contract, or maybe the wife or second person in the family get a job, so we can look at it down the track. Off the plan tends to also be quite an interesting one, where some people have made well with that sort of space and a lot of people haven't. I had one guy who purchased in Melbourne. He went to a seminar and he bought it for $550, and the valuation when it came up for settlement came in at $420. So the solution I came up with for him was he had an unencumbered home. We could cross-secure that. In this instance, he should, so that he doesn't come out of it in a negative manner. But he wasn't impressed with the interest rate for the investment loan, so he just walked away. So basically walked away with a $55,000 deposit that he lost. So
he was happy to wear the loss.
He was happy to wear the loss.
Yeah.
It was just a bad story, and that's what we tried to help people not to do. Then we had another one where a client had purchased in Parramatta a 2-bedroom unit for $750. We got 3 valuations. One came in at $680, second one came in at $715, and the third one came in at $750. And at the end of it, happy clients, they went to see the pre-settlement inspection and asked them, how was the apartment? They said, the rooms are a little bit smaller than what we hoped for. And that's what you get for $750,000. So it sort of goes to show that you do need to do due diligence. But at the time when they went to buy the property, they obviously got eluded by the glossy brochures. And
Yeah, we're all aware of the changing lending environment and all the changing rules, but Ross touched on earlier the change to the credit reporting, and that's probably the main thing that's happening right now, is the positive credit reporting, where NAB are on board, all the lenders are coming on board. In the next couple of months, majority of lenders will be on board with positive credit reporting. So I know that you've already had a bit of a run-in with that. Do you want to run us through, I guess, some examples of conduct and the fact, and maybe just explain conduct now and why it's so important with debts?
So more important than ever now that with the comprehensive credit reporting, we're wanting to make sure we put up quality deals to the lenders to make sure that when they come back with more questions asked, it can make the file more complicated. So looking at clients' existing debts like credit cards, personal loans, if they've got any existing mortgages, just making sure they're in time with their payments. If they've got a sort of a lax attitude and they've had missed payments or their account's overdue, these things can all sort of fall into sort of the bad side of getting a loan, I suppose. Especially also when they've got less deposit and doing high LVR loans, they're buying certain types of properties in certain suburbs. And if you've only got one or two options with lenders, you want to make sure that this isn't going to be the reason why they're not going to get the loan based on bad conduct. So we've had examples of clients who kind of, when I'm having the conversation with them, they always ask me, oh, do you think I'm good to get the money? I said, I will help you, but I am not the bank. Therefore, we need to double check all their statements, any undisclosed debts, and it's creating more work, but I'd rather spend the extra 10 minutes, 15 minutes going through to make sure that we submit a quality deal so we get a good outcome for our clients.
Yeah, I guess that's a thing. In the past, lenders wouldn't even ask for some bank statements, your savings statements. They would never ask for it a couple of years ago. Now they want them and they want to go through them with a fine-tooth comb. So they're looking for payments, direct debits that come out every month. They're looking for payment to a credit card that's not disclosed. They're looking for these types of things, and then they're looking for the conduct on it. But I guess with the positive credit reporting, they actually won't need to look because it'll be on your credit report, all the debts that you've had and 24 months worth of payments on them. So your actual your living expenses and your declaration for debts is more important now than ever. That's correct, because all the lenders will come back and be able to see exactly where you're at and what debts you've got.
They've actually got on the credit report now for the 24 months conduct, if you've been late with anything, you've got a 14-day grace period to make the payment. If you sort of pass that 14 days, you get a 1 on the score, and then you get a 2 if you're over 30 days and a 3 if you're over 30 days. So I guess it's a good lesson to sort of check your credit file if you are going to apply for credit to see where you're at the current moment, see what your score is, what can you do to improve. If you are planning to do something in the next couple of months, if there are some living expenses or undisclosed debts or something that you're unaware of, probably best to sort of close up those limits and try and create a cleaner profile for yourself so you put your best foot forward moving, because there's no hiding information anymore with the lenders. So it's just really important that you take that proactive approach to looking at yourself first before you make that application.
I've heard that they're looking as far and as deep into all the transactions you make with Sportsbet.
Yeah.
I saw some funny things as a poor person who unfortunately couldn't get a loan because they had doing it was race season, I suppose spring carnival, and there was a bit more betting going on during that time. So they questioned him quite a bit, I think. So. And
what about, I guess, living expenses, particularly when you're going back to an existing lender? I know you had an experience there.
So this was an interesting one. So I helped a customer and her husband who just recently relocated from the UK. So she had moved back to Australia back in November. She banks with HSBC, and she declared, I think it was like $4,500 a month for living expenses, so she could refinance the investment loan into her owner-occupied for the one-bedroom unit. And it was probably April, her husband came here and they decided to upgrade and buy a larger home. So they went back to HSBC and they declared $4,000 living expenses for 2 adults. So obviously the information she supplied back in November was on their credit report system. And they could see there was a discrepancy between how can one person go from $4,500 a month to 2 people at $4,000 a month. So that kind of created a 5-week delay for them to get the approval from the lender. And what it was me looking at the scenario and going, look, obviously you've got all your lending with the HSBC, let's look at other options. And we looked at other options and we were able to make it work. So it's just important, once again, if you are playing with finance and you do disclose information to your lender and you do need to go back to them to raise equity, just make sure the consistency of your information is there, because they've got it all on file and it's not like they're going to forget. Yes, you might have different credit assessors, but they've got a record of your transaction history and what you've been doing. So very important that you know exactly what you're disclosing.
Yeah, thanks Prashant. I think we might move on from lending, but I think it's just the type of environment where you've got to be organised and you've got to know what you can do and certainly be approved before you make action. That's probably the other big thing we're seeing is people coming with contracts that are unconditional, or we had a client that had knocked down their house ready to rebuild, you know, without knowing that they can get the money for the next stage of what they're looking to do. So it's certainly not easy, but it's possible. But we need to make sure that we're seeing people early and getting approvals early, so we can make sure there aren't issues with lending, because it's certainly a different environment than we've seen over the last few years. So I guess the advice there would be organised, be diligent, be thorough in your information, have great record keeping. But really important message, I guess, from tonight in regards to lending is the positive credit reporting is here. So a missed credit card payment would never have had an issue for you previously, but it will create a question from a potential lender moving forward. So watch your credit.
And if you all check your most recent credit card statements, you will see a notice about that on your credit card statement.
Thanks, Prashant. Thanks.
All right, I'll pass it over to Frank. Thank you. The solicitor, your best friend or your worst enemy, depending on which side of the stick you're on.
I thought I got away with it.
Well, guys, Frank Alvaro, a principal from AES Legal, been in the game as a property and business solicitor for over 30 years, and he's my personal solicitor. He's been helping me many, many times, and it's a person that I call to get a lot of advice from. Now, Frank, 30 plus years, you would have seen a lot of different things, especially with property over a number of different cycles. Mate, what can you tell us of things you've seen at the moment, from contracts, issues with properties, where your clients are having to say, Frank, I need your help? What's happening, mate?
Where do I start? I guess if you get a good lawyer, I think I'm a good lawyer in property, is get them to thoroughly know the contract. I'm talking about before you're signing. And if you know the contract, he knows what he's talking about, he or she knows what he's talking about, you'll avoid 90% of the problems. Off the plan is still an issue, particularly with apartments. Demanding of release deposits is another issue. It's still going on.
Can you just explain release of deposit? Because it's something I always hear. Jeremy, what is a release of deposit and what does it mean?
Well, let's start with what a deposit is. Most of you who have bought property will know that when you buy property, it takes a period of anything between 4 weeks to maybe a year. There are still some people out there, like first homeowners, think you buy a property today and you walk in tomorrow. But you pay a deposit. The standard deposit is 10%. And what a deposit is, it has two functions. It's a part payment, which is held in trust usually by a neutral third party, typically the agent. And it's also an earnest or a form of security. So if the buyer does the wrong thing, the seller can have access to that deposit in an extreme case. For example, and it's happened to clients of mine twice in the last 30 years, where the buyer does a runner. You know, it's all very well you can sue them, but if you can't find them, what do you do? Well, the deposit is a form of compensation. You do get a choice under the contract whether to sue the wrongdoer or to forfeit the deposit. So that's what the deposit is. Now, what a trend has started some years ago, and I'm old enough to remember, where sellers have put clauses in contracts where they require a release of the deposit. Why would they do that? The usual reason is that it started off with residential sales, where you're selling a property, you're buying another one. Oh, geez, I need a deposit for the one I'm buying. Oh, I don't have a spare $40,000, $50,000, $70,000. I'll get the deposit being paid on my sale to pay the deposit on my purchase. Problem is, the deposit's held with the neutral third party, the person we call the stakeholder. So they put this clause in the contract. So most lawyers acting for a buyer would recommend not to agree to release the deposit. Why? There's a risk. It goes to a third party that is not involved in the transaction, so if something goes wrong, it's harder to get your deposit back. You've got the right to sue, but if it's held by the agent, and something does go wrong and you as a buyer is entitled to deposit back, you'll get it back virtually straight away. If it's with a third agent who's not related to the transaction, you've got next to Buckley's of getting it straight away. So there's a risk there. Another risk is when you're buying from a developer. Meriton is a culprit here where they absolutely insist on having the deposit released to them. In fact, I always have recommended the clients buying from a developer never ever agree to a contract which requires a release of the deposit when the seller is a developer. Developers go broke. They go broke all the time. Meriton gets away with it. I don't know how, but my advice to clients is you take a risk. The alternative is to walk away. And some do. I've had a case in the past where we've sat on a contract for 4 or 5 weeks where we insisted the release deposit clause come out. The developer says no, no, no. Eventually they give in. So the deposit gets held by a neutral third party and the developer does go bust. And the clients think, well, they thank me for a start, but I feel a lot better they haven't lost their 40, 50, 100 grand.
I think the big topic at the moment is off the plan, right? And we're starting to see units being slapped up within 2 years or less than that. And I've just had a client recently who took a property in Little Bay. Richard Cooks was a developer, and this unit was a mess. So much so that I didn't believe what she was saying. I met her on a Saturday and actually physically went out there to see it. I've never seen poor workmanship in my life. Probably as bad as what Scott faced in Queensland. What are you recommending to those particular people who are, going through a pre-settlement inspection or have gone through their pre-settlement inspection? You've got the agent and the developer hounding them. Notice to complete, notice to complete. What are you saying to those people?
We go back to the contract. That's the first thing. So what rights does the contract give to us? If we're not getting what we agree to buy, we can delay the contract. So if we are making for a buy and the seller's threatening or it does issue a notice to demand, notice to complete, first thing I do is deny the validity of that notice, if there is valid grounds. But there's problems not only in the physical side, that is the inspection, but there's also problems that can happen in the contract itself before the build actually goes up. We had a situation last year, a client of mine who's very astute, he's very experienced. He went out looking for a property in Wollongong. He knew exactly what he wanted, which is a unit with an aspect to the ocean with 2 parking spaces. That was absolutely critical because they were looking at when they do retire, they might live there and they needed 2 parking spaces. Very hard to get. They found one, comes to me, I go through the contract. Where's these 2 parking spaces? There's a diagram there. Imagine what's meant to be a parking space for 2 cars in tandem, but there's a line drawn through the half. Why did they do that? I mean, okay, the bottom half is marked parking space, but the top one isn't marked. I'm a bit suspicious. It helps to be cynical too. So anyway, the other thing that happened in that particular contract, same contract, is the buyer was shown floor plans. One floor plan, typical floor plans for that development. One floor plan had a balcony going across 3 rooms, the living room and 2 bedrooms. So you can imagine a great ocean view across, and you have a balcony going across the 3 rooms. And one other typical floor plan had the balcony probably big enough to put 1 chair on. So, well, it's just a design. I mean, so he was told he would get the floor plan with the balcony going across the 3 rooms. So there's no floor plan in the contract. So what do? It's 2 things. I asked the other lawyer, we want this parking space marked as parking space, and 2, we want a copy of the floor plan in the contract, the one we were shown. Well, I actually had a copy. They came back and said, your client knows about the parking space, get him to speak to the agent told him. With the floor plans, we've never heard of attaching floor plans to a contract. I don't know, it's probably the first contract he's ever done because I always see floor plans. The client did contact the agent. The agent did the typical, that car space. Oh, we had to do that because if we make it 2 car spaces, we can't get a DA. So my client walked away from that. He needed.
And the issues is it reselling? You can't resell.
Oh, reselling. Problems with the owners' corporation in the future. When they put a cage up it was storage space, by the way. When they put a cage up, we can't park in it. We have complaints from the neighbours. Why is he getting 2 spots? We've all got 1. All sorts of problems. And like you said, with resale.
Yeah. Now the big thing I hear, and we'll be quick about this, but Jeremy, do I need to get all these reports You know, section 93s and owner's contribution reports. Is it necessary? Am I getting, you know, taken for a ride by the solicitor? In short, reports. What are the necessary ones we definitely need to get? What are the luxury ones? If you can give us just a quick rundown.
I don't think there's any luxury ones. The luxury ones probably would be having a dedicated property inspector build for you. I think a lot of clients, they balk at that, even though it's recommended if they're building. But definitely pre-purchase building inspection report, pre-purchase pest inspection report, and in a case of strata inspection report. We had a strata inspection report come back a couple of months ago where there was issues with council, there was issues with the New South Wales Administrative Traders Tribunal, Tenancy Tribunal. It was a commercial unit, but what happened was the owner built himself a unit in there. He lived in it. Knocked out windows, knocked out doors, and there was proceedings against him, and that came out in a strata report. Needless to say, my client walked away. The other side wouldn't budge, they wouldn't negotiate.
And you were seeing some nasty things, guys. You know, people selling just prior to knowing that there's going to be a $30,000 one-off contribution.
Yes.
Someone buys the property, and guess what happens 2 months after they bought the property? $30,000 strata bill. That is not uncommon. I've seen that a couple times. Manzurul can share. He's seen that a couple times as well, and you know it's common. You know, I haven't got 30 grand to pay the body corp. I'm going to sell it quickly, flog it off, and let someone else who maybe hasn't got the right reports to deal with the issue.
That's true, but it doesn't always come up in a report. A good strata manager will minute everything, and a good strata inspector will pick that up. But there is an element of risk in any transaction, and that's one of the risks. It won't necessarily come up. But a good someone with a good eye, both your lawyer and your strata inspector should be able to pick that up if it's in the report, if it's been minuted. Because what a good strata report inspector will do is copy the minutes of the various meetings, get copies of the notes, get copies of the various quotes. Sometimes you get, what you do pick up, they get copies of quotes which aren't minuted. The plumber one you mentioned, we got a report earlier this year where there was nothing in the minutes, but there was a string of plumber bills or quotes. And from that we ascertained there was a big drainage issue, and in the end the client still bought it, but he bought it with his eyes open.
So conveyancing is just more than the transaction of moving the property from one person's name to the other. It's going deeper into the contract. It's going deeper into the actual property transaction itself. It's understanding why someone wants to sell. You know, one of the questions I always ask to the agent is why is the seller getting rid of the property for? And I just try and, you know, pick up little things here and there to understand, are they getting rid of it because it's a lemon? Are they getting rid of it because they want to move on? And then I go to my solicitor and I say, give me 10 reasons why I shouldn't buy this property from the contract. And we spent a bit of time to go through it.
Yeah, we had a situation a few years ago where the warning bells were there, but we just couldn't put our finger on it. The client had already signed the contract. We couldn't get our pest inspector in. The vendor kept on delaying, all sorts of excuses, and as a result we kept getting extensions of time to the cooling off period. Eventually we got told you can inspect it on this day and this time only. That was the only time we could inspect it. So the inspector went in there, came back, report was good, positive. Then when it came to settlement, same thing happened. We were supposed to settle on a particular day. It was just before school started, beginning of the year, and the seller refused to settle on that day. They would breach a contract, but they refused. As a side issue on that, the clients had already packed everything, and they had to go in a hotel for 3 nights. They had kids, they couldn't send them to school. They had everything packed up because the seller was just being pretty recalcitrant. Anyway, they move in. 3 or 4 months later, get a phone call. The place is absolutely infested with termites. What the seller did, why they restricted the time and when we could go to where the pest inspector inspected, was they went through, they scraped away all the termite tunnels. It was a house on piers. They repainted rooms. This is all in the space of a few days after we'd signed the contract. Needless to say, the client was pretty stressed. I gave them some advice. They eventually decided not to take that advice, mainly because they didn't want to go through the stress all over again. But there was a clear cut. Oh, the other thing that happened in that, we found out afterwards, there were 7 previous buyers who rescinded it during the cooling off period. and we know why now.
Beautiful. Well, thank you very much, Frank, for of your little points. I do appreciate it. These guys will be sticking around, so please feel free to ask as many questions as you can. Not very often you get a solicitor which is going to give you a bit of free advice. So stick around and ask a bit of question.
Just one more thing, Jeremy. I think the lesson is have a team around you, and that comes from your lender to your broker to your building inspector. And if you do this often enough, you develop a rapport with your advisors, and that includes lawyers, you'll get to know each other and you know how they work, and there's an element of trust there which you can basically bank on.
Beautiful.
Huge thank you to Richard, Scott, Prashant and Frank for giving up their time and sharing all their knowledge and their expertise, and their traps that they've tripped up into and how they might avoid it moving forward. I think lots of lessons to be learnt from all of them. So thank you again. Cheers, gents. Next step. So as Frank said, the thing that you need to have around you is a good team. If you'd like to speak to any of the guys, if you'd like to speak to Munzerl or Prashant or any of the Aussie guys, please get in touch with us. We'd love to have a chat to you and help any way that we can. The next seminar, Jeremy, is 23rd of October. Great topic. Richard Daly. It's a fast money, slow money development versus natural growth. So it's really looking at, can we make some money quickly, chunks of money to reduce some debt, develop a duplex, what can we do, as opposed to buying something and holding something. Because just because you're buying something that you can do something on doesn't mean you have to do something on it. And just by getting a DA like Jeremy did on a property that he had in Victoria to then on-sell it, there was the same profit there as actually going through the whole development and doing it anyway. So we're going to look at the pros and cons of development versus natural growth. But we appreciate your time tonight. Happy to answer any questions afterwards. Thank you all very much. Thanks.